It's good to be back and good to have Richard back. Okay, if you have some questions about trend following or trading or anything, the markets, commodities, you can send me some questions, direct message, or raise your hand and I will make you a speaker. And let's try to keep comments, monologues to a minute or two. And if I decide to mute your mic, I'll bring you back. Um, Maybe in the future we'll set up someone to mute my mic. I can't be trusted either as far as going on and on sometimes. We've had a couple of good tweet streams going this week a few I kept up with. One was, oh yeah, trend following stocks. Why doesn't someone trend follow stocks and raise billions of dollars because trend following is great for stocks and there's no one doing that. And then number two, this I guess in the past few days there was a old debate about whether we have too many trend followers or too many convergent traders, and what causes trend following problems. Too many trend followers or too many convergent traders? Maybe I misspoke. And then, of course, how do we, in these illiquid markets like orange juice, how do we don't want too many trend followers there. True. I love orange juice. Once one of my first big trades was in orange juice in 1988. There was a big, I think it was 88. There was a big, so I just started Chesapeake and I just got a chance to trade orange juice for the first time. And I had one client and it was a fairly large client and they were allocating to CTAs, Wall Street client. And so I got long OJ. And it just so happens they had in their group of managers an OJ expert. The guy only traded at OJ. So so that was a good test because there was a big bull market in 1988 in OJ, and I was long, and I think this OJ expert was short, so it did not work out well for him. So I think I inadvertently became the OJ expert. Of course, not so much, but that has happened to me a few times too, where the experts have been on the wrong side of massive trends. 2006 LME copper, I know that was one. All right, let's get the show going, and any topic that you're interested in is fine with me. Good morning, Richard.
Look, might have to take a bit of a back seat and join in when I get my rhythm. I've sort of had my head out of things for the last couple of weeks, but looking forward to tonight's session, Jerry.
Yes, it's good to have you back. Well, you hopped right in there on some of these Twitter debates, so it didn't take you long. That was good. On this convergent divergent, I know for my entire career, I was like most people, thinking that, well, you really don't want to have too many trend followers. That's the main problem, too many trend followers. Back in '88, when I first started, again, this group that I was managing money for, they would go out and find managers and build a multi-advisor CTA funds and portfolios. And I remember them telling me about all these new managers that they were finding. And my first question was always, oh gosh, is this a trend follower? And usually it wasn't. And so I was very happy about that. But then when I met Richard, he was like, well, not so fast. We really get a lot of problems from convergent traders. And I think it's fair to say, but he's here and he can correct me, that it has a little bit to do with this idea of making it choppier. Like we're going along fine on this trend. The trend has a long ways to go. In hindsight, it had a long ways to go. However, over these 6 to 12 to 24 months of a trend, we would see, counter trend activity. And this was totally due to convergent traders, convergent trading, because a lot of managed futures CTAs have convergent elements, convergent characteristics in their trading with the vol management, correlation management, dynamic sizing ideas. And so this causes problems. We have to have looser pants, we have to have looser stops, and we have to sit with some of these drawdowns. Some of them are fakes, and they will go. The market will go back trending right back to the highs, keep going for months. And of course, some of them are not fake. That's the end of the trend. And then I do, and so that sounds reasonable to me. And then, but of course, we don't want billions in dollars trying to invade our OJ market. And that's one of the nice things about, well, not a lot of nice things about being small, but that's one of the things that I like is that I am trading some of these smaller markets like OJ. And OJ has been very choppy from day one. Um, but I think the convergent trading is does make our performance more lumpy and harder to hang on to those trends sometimes. But I think it's two different things. One is that's definitely true, and the other is we can get to be too large in a certain market for a certain market, and we won't be able to trade it.
Yeah, that's right, Jerry. Yeah, the way I see convergence and divergence, I put up a post this week which, just from my perspective, displays them as almost polar opposites. And the edge of convergence is different to the edge of divergence, and the edge of convergence is based on the principle of negative serial correlation. In other words, a low follows a high, then we get another high, then we get a low, then we get a high, then we get a low. It's this oscillation about an equilibrium where the sign of the correlation reverses at incremental steps. But divergence is about positive serial correlation, where the directional move is perpetuated, it endures. So a high follows a high, a low follows a low, in that sort of sequence. Now, those two different forms of serial correlation, and really any speculator in these markets requires serial correlation to extract an edge from the market, because if they don't have a serially correlated series, then each of the price intervals are independent to each other, and that's a noisy market, or one described by a normal distribution. There is no edge when there is no serial correlation present. But the two forms of serial correlation, negative serial correlation or positive serial correlation, is the edge that an investor or a speculator is effectively extracting from the market based on the principle that markets are not purely efficient in nature. They're not totally represented by a normal distribution. There are times where we get regimes that express tail behavior with positive serial correlation, and there are times where the market expresses this oscillation about an equilibrium, or a tendency towards an equilibrium. So what these two countervailing forms of edge that can be extracted from a market are working from two principles of the market behavior, which relates to feedback cycles. So what's causing this serial correlation effect is a lag effect in the price series, where an earlier price point is correlated with a future price point, but it can be negatively correlated or it can be positively correlated. And what's causing this is feedback. And in the convergent regime, we get this negative feedback. So what that does, because the high follows the low, follows the high, follows the low, what that negative feedback does is it's reversing the sign continuously, plus minus, plus minus, plus minus, to oscillate about an equilibrium. And that produces a dampening effect. It actually makes the market tend towards greater equilibrium when we get these countervailing forces that are continually offsetting each other from trader impact. So the negative feedback is perpetuating equilibrium. The positive feedback is perpetuating this transition away from the positive serial correlation. it's perpetuating this move away from equilibrium, the move towards chaos, the move towards disrupted markets. And so these two forms of behaviour, um, they're not equally being represented by speculators. The vast majority of speculators and investors are actually adopting convergent practices or convergent behaviour, which is focusing on this predictable nature of the market, which is associated with having a stable mean and a stable standard deviation. Markets are stable around an equilibrium. They're predictable about an equilibrium. And so the vast majority of speculators and investors, or 90% of them, are effectively extracting their edge from this convergent nature of markets. But what happens with the divergent trader, there's vastly a smaller number. There's about 10% divergent traders when you look at the total number of speculators, the total number of investors. What is the behavior they're exerting in the market to create this trader impact or this order flow imbalance? And we have this 90 to 10% relationship. So what happens is that because of this imbalance, we find that when these convergent traders find that markets snap out of this predictable condition, they are exiting from their convergent behavior. They've got to exit from that behavior because their models are no longer working. The models that were dependent on this stable regime, the models that were dependent on extracting an edge because of the assumptions surrounding the equilibrium tendency, they break down and they've got to extract themselves with their models by exiting their trades. As soon as they do that, of course, they are therefore creating a divergent behavior from exiting their trades. And those that are leveraged, who apply convergent practices, that divergent behavior, the force of it is significantly even greater still. So when markets start getting chaotic in nature, we get this squeeze, the typical short squeeze, the typical long squeeze. We find that the convergent traders en masse start having to abandon their models. And so this 90 to 10% relationship suddenly changes. We go 80, 20, 70, 30, 60, 40. So when you're starting from a very low level of about 10% practitioners of divergence, and we start seeing suddenly that we are now being joined in the behavioral tendency by the convergent traders who are abandoning their models, we get this non-linear amplification of these enduring trends because the positive feedback associated with divergence amplifies because it is all directionally the same way. So unlike negative feedback, which suppresses over a course of time. So when we talk about is something too crowded, typically that means that there is a finite level of alpha in there in the market. And we assume that all of the traders that extract their edge from that pie of available alpha, we're assuming that it's all negative feedback because we're assuming that that edge dissipates over time. But in reality, a divergent trader with positive feedback finds that it amplifies over time because it's the same directional serial correlation. It's not offsetting each other. And so when people say, is trend following too crowded? Well, of course, orange juice is a good example, but that's a very small market. But the general principle is that the more divergent traders, the more behavioral tendency towards divergence, the greater the level of positive serial correlation and the greater the enduring trends that are created from that behavioral tendency. So this changing mix of participant behavior when markets suddenly get out of their predictable rhythm actually creates these enduring trends. So that's what I was trying to portray in those tweets this week, but I don't think it was getting across very well. That's the message I was trying to get across.
Yeah, I agree. That's brilliant, and I think you can't do any better than um, guiding some of these questions to appearances on top traders with Niels, because you've done so many great explanations on there, and I highly recommend for everybody to go back and listen to all those episodes where Rich appeared. It's so much you can learn and a deeper understanding of trading and trend. I get questions every week about how can I learn how to trend follow? How can I get better? Tell me about a book. You know, these great Rich's website and the podcasts are just fantastic. I've learned from them. But would you technically say that? Yeah, I was listening very carefully, tried to find something I could comment on. And the only thing I thought of is that would you really say, though, that they're abandoning their strategy or they are abandoning convergence because part of their strategy, in order to stay alive, has, like us, may have a stop loss where they have to reverse and have to no longer rely upon convergence because the markets are now starting to diverge.
Yeah, the way I see it is that convergent traders unfortunately have this negative skew in their strategies, which means that during favorable regimes, they get these beautiful linear equity curves, they get very high win rates, things are going smoothly. There appears to be no sort of risk in what they're doing, but the signature of negative skew demonstrates what happens when those models fail. Now, the symptom of negative skew typically shows up over a period of time as a significant drop in their equity with a very fast moving drawdown that really ramps up. So the problem is that typically when you see this negative skew, that often markets just revert back to their prior predictable nature, and that negative skew is sort of a once-off occurrence. You've seen it occasionally. But what happens when the regime actually changes and no longer are the models that they're using, because the convergent traders, they're unlike trend followers. They don't have these risk mitigation mechanisms built into their strategies. We have our small bet, we've got our tight stop loss, we've got our trailing stop. That they're design mechanisms we've got to manage risk. But a convergent trader, to extract their edge, they typically don't use those principles of risk mitigation. What they do is they use principles of correlation. They use principles of an understanding of the predictable nature of those markets to determine risk thresholds that their models should operate within. And they recognize that, well, only very occasionally in our backtest have we ever seen these models work outside those risk thresholds. It's a classic margin call, that moving margin call where we see, that company that supposedly was Lehman Brothers were operating with models that suddenly this quant realized that they were working well outside their thresholds and they were exposed to significant capital loss. That was a convergent based trading model, and that's what most traders work with. They work with the principle of this predictive basis of their back test gives them these risk thresholds where their models operate within. We're much more, we stamp our authority on risk management to say we do not know what the possible risk events are in the future. They're vast. But what a convergent trader says is that, well, we're assuming that the predictable nature of the market is sufficient to tell us what our risk thresholds should be, what our Sharpe is, all of these things. They're using these Gaussian metrics to basically determine these risk thresholds, and lo and behold, when they get into this very unfavorable regime, this negative skew that is built into their models, because they don't have these risk mitigation measures embedded into their programs. So trend followers have this good positive skew, and that is a symptom of the designs built into their models that manage that left tail risk. So we never let our risk go too far to the left tail. So inevitably our strategy produces this positively skewed signature. Convergent models don't have that benefit. Their assumptions and the way they extract their edge is based on this predictable condition of the market. And when you get that negative skew signature, all you need is a couple of those consecutive losses, which are significant because of the negative skew, that they suddenly find that they're heading towards risk of ruin far quicker than they ever anticipated. Now, A trend follower rarely meets risk of ruin because they've got positive skew and they're always mitigating their risk. Yes, they get lots of small losses, and yes, their drawdowns can get quite severe. But as their drawdowns get more and more severe, their risk is being released through the fact that their stops and their trailing stops are exiting them from that adverse risk situation. Convergent models don't find that luxury, and they find that their risk actually accelerates and they get consecutive strings of losses and they meet risk of ruin head on. So that reason for that extreme risk event forces them out of their models. They can no longer afford to hold on to it because they know clearly that suddenly they've never seen this before in their back test, but now they're heading towards risk of ruin and they've got to extract themselves from that trade. Some of them are braver than that. Some of them say, let's average down into that situation because I believe that the markets will return to their predictable state. And I've only got to sit through this adverse period, hold my breath, martingale into my position, and lo and behold, they're the ones that are even more extreme cases where if it fails, that when they turn into a divergent behavior by exiting from their models, that really supplements the trend follower because it creates these capitulation tails you see in these extreme trends when we get these massive trends. So that's the way I see it.
That's right. And this is why over the years, people have asked me, like, why don't you want to diversify your strategy and add something different to it? And why do you want to be so adamant about trend following only and not doing the carry trade or these other trades? It's because they all have the same negative skew characteristic. That's what's going to fit in better. I'm all for the short-term trend following. I'm all for allocating to ALP, the daily bar trend following. It's all positive skew. It's all trend following. And we're trying to get some diversification in the portfolio. And you and I will have system one that's shorter term and system four that's longer term. And we're trying, but we want to keep it with this positive skew and making these good bets and being able to control our risk and our capital and being on the right side of surprises. So it's not because I'm some ideologue and I refuse to pay attention to back testing or research or science. It's that these counter trend convergent methods, they really have some negative characteristics. And what's the downside of trading hundreds of markets with systematic trend following with multiple systems, look back periods, shorter term trend, medium term, and long term? You're going to have volatility and bumpiness. Oh my God. Let's try to deal with that. Let's go and have some psychological counseling on how to do the right thing and maybe think for a second that it's us who needs to fix ourselves. It's not the systems that need to be fixed because they're perfectly wonderful and fine. And we need to figure out how to become more disciplined and how to pay attention to what's meaningful and real and not let clients push us around and pollute our trend following systems with lower, robust, non trend ideas. Wow, I went off on that one.
You're
Hello,
right,
Jerry.
though. You're spot on. Like, people often say to me, well, look, now that you recognize that there's an edge to be had in convergence and there's an edge to be had in divergence, why aren't you adopting a portfolio that's getting the best, the benefits from both of those solutions? Now, the reason I don't is because I know that there is negative skew in that convergent model. And whilst there is this temptation of having this beautiful sort of, almost sort of diametrically opposite return stream, uncorrelated return stream to my divergent section of my portfolio, I'm not going to compromise my portfolio with the risk of that negative skew because I know the impact that is if it's not treated well and if it's not strictly managed. And as soon as you start strictly managing that negative skew, you lose the edge in that convergent model. So I just don't believe there is a need to play at all with convergent models. So they're time bombs waiting to happen as far as I'm consider, and I can get so much more benefit from just extreme diversification in my divergent models. It's a no-brainer to me. I will not consider mixing my portfolio of convergent solutions.
And then what's our bogey? Our bogey is the S&P that makes 8% a year and a 50+% drawdown. And there's no way, if you trade currencies, commodities, stocks, and bonds, long and short, you can come up with a strategy that's nearly as bad as that. Sorry, Mike. How are you doing?
Hi, Joy. Hello to ideologues. So, many trend followers are ideologues during the week, but they are pragmatists during the weekend, from what I can say when they backtest. Anyway, yes, about the positive skew of trend following, it comes at the very, very high price. And this is the discipline and a dead decade from 2009 to 2018. What did the positive skew accomplished? Nothing. Convergent strategies did very well. I just posted in my Twitter account an article that shows defining something as convergent or divergent depends on the metric. And some trend following systems are actually convergent to some mean. So I don't believe in this demarcation. I find it irrelevant. For example, in 2017, the stock market had an excellent trend. And it was mean reverting. Serial correlation was negative, highly negative. And mean reversion strategies did very well, but there was a strong trend. You can have trends. I keep saying this for many years. Trends develop with positive serial correlation or negative serial correlation. It depends on the jumps of prices. So a trend following system can work well in negative correlation and can also work well with positive correlation. What doesn't work is the short-term trend following. What people did in the 80s with a 10-day moving average. That doesn't work with negative serial correlation, but no one nowadays does short-term trend following because it doesn't work. So the demarcation of serial positive negative correlation ended in the 90s when markets became mean reverting. Markets are mean reverting. I just posted a chart of gold with the 120-day serial correlation. You will see in Twitter, you will see this is a mean reverting market, yet there were some excellent trends in that market. So I don't believe in this demarcation. And there is something else, the convergent rates, they have an average holding period of a few days, 2, 3, 4, 5, maybe up to 7. In trend following, we are talking about months, years. So how can we compare these things? You cannot compare. The negative skew, it comes from the short holding period. And the way you deal with the risk is you control the allocation to the strategy. Not to the trades, to the strategy, because with convergent trades, you cannot use stop loss. It destroys the benefits due to negative serial correlation. So I think, if you read my article, convergent versus divergent trading strategies, you will get an idea why this is not a good demarcation at all. As far as I'm concerned, in my opinion, we can talk about long-term trend following versus short-term trading. Yes, there are problems for short-term trading. You know, it's transaction cost, it's the negative skew, but you know, when you exit trades in 2 days or 3 days, it's more comfortable for the trader. This is one reason many traders become short-term types. And this is my idea about these differences.
Hi guys. Hey Jerry. Hey Richard. Hey Michael. I mean, this is a very interesting conversation actually. So, what Richard was talking about, I agree with what he has elaborately actually explained, and it is quite nice to hear when he talks about the way he talks. There's only the only piece that I would like to mention is in the marketplace there are, you know, especially trading futures, there are producers and there are hedgers. So for me, the act of speculation is providing like an, you know, insurance activity. So, you know, the total number of the total impact of speculators should not be too large. And I don't think if in a very liquid market like corn or wheat, I don't believe that the divergent or convergent speculators would have the power to impact the prices on a material way. So what happens is this. So as a trend follower, so you get these small losses, all right, and each of those losses they are like an insurance activity. So you get one loss, the second loss, the third loss, the fourth loss, but the fifth one pays for those losses and some more. So there is definitely a, you know, when I imagine in my mental image, I see marketplace, especially the futures trading with producers, there are hedgers, and then there are speculators. So there are three main activity groups. And within those three, Richard has mentioned the fact that the divergent ones are 10% to 90%, but the numbers is just not close to me. At the moment, I'm sitting in a cafe, drinking coffee and listening to this nice conversation. It's just, I believe we are not material in any shape or form. So that's what I wanted to mention. The second thing is, you know, to be able to trade a strategy, I noticed that you know, your belief system, the way you look into life needs to be somewhat aligned to what you're doing it. So, you know, so these are sometimes our very core beliefs, which I call limbic beliefs in the brain. There are these deep-rooted beliefs about how we look into the world. So, if you are a, you know, if you are a kind of person that enjoy trading mean reversion, I find that it is not all the time possible to trade trends as successful. So, or at least I've never considered it for myself. So that's one thing. The second thing is, I mean, just to be able to trade one strategy takes a lot of time. So, for instance, I'm working to better my system for years now, and it takes a lot of time, guys. And I do have a belief that to be able to make your systems better, your trend system, trend following system, or any other system, it may take a good lifetime to be able to just make that system better. So there are different components that you can work on, and you know, just jumping on the second strategy, then the third strategy, I'm not quite sure how successfully you can execute those strategies. So anyhow, so that's my take on the subject. Thanks a lot.
The other thing with the serial correlation, the positive serial correlation, is that it is arbitraged out of the market quite fast. And this is occurred especially in the stock market after the 90s, when all these technical traders, the technical analysis traders were trading the positive serial correlation. And it was very high in the 70s. It was like 0.6 for the S&P 500. And then the algos came in and they took out of the market all these people. They shook them out that traded those positive correlation strategies. I think trend following can do well in both regimes, but convergent, what is actually the mean reversion strategy, does better with the negative serial correlation, of course. But trend following can work in both regimes.
Yeah, I've got no doubt about that, Mike. I often, when I look at any form of speculator, I come quickly to the conclusion that we actually are all trend followers, except those that sell options and get the premium from the selling of the options, because we're all looking for a move in price from a lower point to a higher point, or a higher point to a lower point. And then we get a classification into, well, are you trading around an equilibrium, or are you trading for the outlier? And that tends to separate then, for me at least, how I would define a convergent trader versus a divergent trader. So I understand you've got your concerns with it. I agree that the stock market itself is mean reverting in nature, no question about that. But would trend followers invest 100% of their portfolios in stocks? Well, no, that goes against their entire principle. They would be diversified across futures. They'd be diversified into cryptocurrencies. They'd be diversified into bonds, etc., etc. Wide asset class, dispersion in their diversification, and so they're not focusing purely on stocks. But I do agree that we have seen a mean reverting tendency of equity markets over the past 20 years. But when I'm talking about this, I'm talking about an outlier. So an outlier is something of significant magnitude, well beyond what the normal distribution implies, or Gaussian statistics implies. There is something that is creating that significant magnitude. It's not just random. There's something driving it. And to me, that is this positive serial correlation, because it goes well beyond the trend created through a mean reverting series. We can get good trends in mean reverting environments. Of course, counter trend is a trend. But the central point, or the difference to me between convergence and divergence, is where is the equilibrium? Are you transitioning away from that equilibrium, or are you transitioning towards that equilibrium? Because the definition of that equilibrium is where the trend ends. The tendency is towards the equilibrium, and as soon as it sort of gets close to the equilibrium, it might go through that equilibrium, but it's going to revert back to that equilibrium. It's going to end that trend and change the direction of that serial correlation. So to me, when I'm talking about positive serial correlation, I'm specifically talking about classic trend followers, and this 5 to 10% of the trades, which are the outliers, are being driven by this positive serial correlation.
Yeah, I think what you said is the smartest thing I have heard for a long time, that everyone is a trend follower. But I will remind something. It depends on the metric. For instance, the daily returns of the S&P 500, it's a distribution with fat tails. But if you take the annual returns, is a normal distribution, very close to normal distribution. So someone could say I'm a mean reverting, trader on the yearly time frame. For instance, this year the market is down, I will go long. There is so much relativity, not in the physics sense. There is so much relativity in these concepts. But what you said, it boils down to this. Everyone is a trend follower. Even in high frequency trading, you are trying to get a difference between some bid and ask price, a trend to make money. So I agree with that. And I think, you brought up a point about stocks. I remember when Systematica, Lida Braga, you probably know this hedge fund, they try to mix mean reversion short-term trading for stocks. And then at some point, she dismantled the whole department and fired them because they couldn't, generate profits. And at this point, I would like to ask Jerry if he wants to answer this, because he says he's trend following stocks. In the last 5 years, what percentage of the profits for him came from stocks versus the traditional future markets? I think I would be interested in knowing the answer.
Well, it's a complicated subject. Number one is my confidence in some of these statements, it ranges. So I may not be 100% correct, but I think that to some degree you need to, every market has these mean reverting characteristics, maybe 90% of the time, or I've made a lot of money in gold on long-term trends and on these outliers, and then gold goes back to being mean reverting for years. And so I think that it just depends upon how you handle these outliers and how many you get. And then another thing too, I don't think that it's correct for trend followers, and this is the only lens I have to and only care to view things in is in terms of trend following. So I don't think it's appropriate for me to talk in terms of the stock market and trend following in the same sentence and talk about indexes. I'm not going to talk about the dollar index. I'm going to talk about the yen. It's been a huge outlier, and the Chinese renminbi and the crosses with that renminbi. So I'm not going to look at necessarily. It's not part of my DNA to say how have stocks done. I don't know. I don't look at these sectors. Not a typical managed futures CTA that de facto is going to make money when the sector moves. Because if an outlier comes along, they're going to try to get rid of it. It's too volatile, and we need to reduce our position. So regardless of how successful my overall stock trading was, I can say that I got lucky. We always get lucky with the markets we choose. I trade all the futures and 100 stocks, and I have futures in my portfolio to the degree that they help with diversification. And that's exactly what I did with stocks as well. As I did some analysis a few years ago and said I'm going to put these particular stocks in my portfolio, not based upon historically how well they had done in any regard, other than how much diversification do they look different than the typical stocks out there. And I got lucky in that I had in my portfolio two really big winners, Tesla, and then I forgot the name of the other one, but it was the one that made all the money with the virus vaccines. So these were hundreds of ATRs, and I'd had huge wins in rapeseed and canola as well, nice wins in soybeans and corn. So I don't look at the stocks as a sector, I would evaluate it as how many of these outlier trades that I get. And Tesla was a monster trade, and whether it was a stock or not, at one point it was probably a 500 ATR profit. So that had a really great contribution. And although I do appreciate these big sector moves that we've seen this year in the dollar and interest rates, the classic trend follower is going to set themselves apart from others when they on how they handle the trades that go a long ways, and even inside big sector moves, stocks, commodities, currencies, bonds, whatever, we will see a few tremendous standouts. And that's why Richard and I think it's so important to trade so many different markets. If you are a trend following, classic trend following outlier hunter, if you are a managed futures CTA, you can probably be replicated by 14 markets.
That's exactly right, Jerry. So the way I see it is that if, for instance, our strategies were always in the market, in other words, we're always participating in the market, then trade distribution is going to be correlated with the market itself. So if the market has a dominant mean reverting tendency, we will find that distribution of trades will also be dominated by this negative serial correlation, this mean reverting tendency. But we're not in the market at all times. We're very selective about when we participate in the market. We are flat most of the time in our markets. The times that we participate in the market is far more selective than most traders. When we're trading a single return stream, we might be, over a 30-year period, we might only have 30 trades over that entire 30-year period, but we are only participating in those trades when prices get extreme. So what we are doing is we're changing the nature of the distribution that we participate in. We're not participating in the entire market distribution. We're selective, and we're saying, if I reduce my trade activity to only participate in these material price moves, the reduced distribution I get is going to be more symptomatic of the tail region of that distribution as opposed to the bulk of that distribution. So through our selective stance and how we participate, through you using your breakout models where you only participate when your breakout models signal an entry, which is when price starts getting extreme, you're waiting until the trend is quite material in nature when most people are saying, hey, it's going to mean revert here. You're saying, no, this is the time I get my entry signal when it's quite mature. I'm going to participate in that. When you sum up all of those signals that you get, you will find that you will converge towards the tail region of the market distribution of returns. So it doesn't matter whether markets have this mean reverting tendency or not. We know enough about stocks to know that there are certain stocks which have outliers. Amazon, Tesla, these things. We also know in 2008 that we had extreme price moves in the stock market, 50% drawdowns. They weren't mean reverting in nature. Those periodic moments in time were actually outliers, or this positive serial correlation manifesting. That's when we are participating in that activity. We're not participating in the market at all times.
And then we go from a period where, as we hear very often, that there was this lost decade where trend following kind of broke even. And in my opinion, CTAs don't trade single stocks. They're not going to get the outliers in those indices that they want to trade. They only want to trade futures for some reason. In their managed futures portfolios, maybe, like I said before, there was one CTA who said recently that, yeah, we trade in our managed futures program, we trade indices, but in our other funds, we trade 5,000 stocks. I mean, this baffles me, but whatever. So anyways, we have this period where trend following did poorly because, but in that same environment, the stock market did amazing. There was so many outliers, in some of these markets that you just mentioned, the FANG stocks, et cetera, and CTAs did not participate. It's like saying, well, 2022 is a bad year. How could it be a bad year? Well, I didn't short bonds. Well, you're a dumbass. Then it wasn't a bad year for trend following. And maybe that lost decade wouldn't have been so bad for trend following if people would have actually trend followed some of those stocks that had these outlier moves. And then to top it off, in the next breath, we get, oh, does trend following work on stocks? In other words, does trend following work on the best markets that trended for 10 straight years? Well, I don't know. I'm skeptical. What are you talking about? You're skeptical. It's the only thing that trended.
Hi everyone. I hope that you can hear me now. I'm especially very happy to be here today because I had some program issues first 20 minutes. I want to say that, but maybe for 30 minutes I'm listening to your conversation. It's really very interesting topics today, as always. And of course, for the rest of this topic, I want to say that, of course, proper diversification, and I think that all we know it here, that proper diversification is a very necessary part of our trend following, of our classical trend following programs. And these discussions, does trend following work on stocks or does trend following work on commodities? Of course it does, but the periods of underperforming will be bigger, of course, because we need diversification for the smoother returns, and it's one of the main things. So I'm very happy that now I have an access to our trend following trading discussion, weekly discussion, because I was upset for first 20 minutes.
So this year, well, my broker added 10 crypto markets, and I've decided to incorporate them into my portfolio. So I will be trading them in 2023. Now, within that 10 markets, there will be instruments like, the Ethereum, Bitcoin, Cash, I guess, Litecoin, and a few other, relatively less known markets. But the point that I'm trying to make is, with trend following, you can trade so many markets. You can trade stocks if you can incorporate them into your portfolio, which I'm working on that as well. So I don't think there was any a muted 10 years between 2009 and 2018. It just depended on what you have trend followed. At the end of the day, I see what I do as following up the data. Okay, for me, it's just big data is coming into my database, and my job is to be able to find markets that trend and that provide those outliers. And this week, basically, I've just pulled my hair to be able to find data from 2020, so to be able to add data for those 10 crypto markets. And I've seen them. The crypto as a segment has done pretty poorly during 2020. As a segment, they made pretty good during 2021. So my systems results were pretty bad on 2020, pretty good on 2021, and I would say just average, maybe a little bit positive, but not as good as 2021 during 2022. So, I mean, I'm going to take a big leap of faith. I'm going to risk small, much smaller than the rest of the markets that I'm trading, but I will incorporate them this year because I believe crypto is here to stay, and I see that the backtest results are definitely improving my overall diversity, and it's more of the same data. So as long as I trade small, take a small leverage, and take a small position size, I really don't think that I need to be afraid of trading crypto. So this is back to our original conversation. if you don't trend follow what you have to trend follow, yeah, your results might be poor a little bit. And don't forget that we are not bound only by the commodities or the futures or the indexes. There are stocks, there is crypto, there's credit markets, there's CDS indices, there's corporate bonds and whatnot. So really, you're gonna trade what you have to trade to be able to get back to those outliers. Thanks.
My opinion, when people say trend following on stocks doesn't work, they mean the volatility is high of the resulting equity curve. And the reason is that for stocks, they report earnings quarterly, and the moves are violent. You can get like Intel, it can drop like 20%. You had Boeing, they lost like 30% during the pandemic, and all these large moves that you suddenly get caught in those. And this is what they mean. If you are lucky to choose a good universe of stocks to start with, it's good. Otherwise, you will end up like the ARKK ETF with a 70% drawdown. So it works. The problem is the volatility. So if you add higher volatility to your trend following, and if you have many stocks, like 1,000 stocks, you are going to be better with respect to the index. Why not following the index? Trend following the index. I like to know what Jerry thinks about this.
I mean, I think it just is a situation where everybody has a certain different system and the way they approach the markets and sizing and how they do the trend following, and you can come up with very different analysis. It's almost impossible to make a statement that everyone's going to agree with, because people do the research different. And it doesn't mean they do it incorrectly. They just do it different, and everyone has different ways of doing things. And with what makes it one of the things that I think people have false comfort in is, boy, I really, we all kind of agree what the 50 or 60 or 100 futures markets are. And when we do these back tests, we come up with this analysis, we can all rally around the idea that it's going to be very similar results. But we're dealing with outliers here. And if you have 50 different stocks that I have 50 different stocks from you, then you're going to have vastly different results. So because it's outlier based, if it's futures only, more than likely whatever had an outlier is in everyone's database, because we're all trading futures and we're trying to trade all of them, irrespective of how they, we're all trading cocoa and it hasn't made money in ever. And but we're all going to have it, but we're not all going to have Tesla or these big outlier trends. The world, you got 5,000 stocks or 2,000 stocks to choose from. There was a tweet this week. I mean, it's baffling. I mean, this idea, does trend following work in stocks? There's papers that have been written, and they were written a long time ago. We've talked about it. The Black Star paper, I think it's titled, "Does Trend Following Work on Stocks?" And the Eric Crittenden authored along with Cole Wilcox. But then there was a tweet that, where people have done research and they said, well, I've done the research and it does work, trend following does work in stocks, but it doesn't add value to my portfolio. So you would just have to dig deep into this. What are you doing? Show me what you're doing. Show me how you're doing it. And then to come to some sort of reasonable conclusion. Everybody has different, it took Alp a long time to explain, for people started understanding that there is a big difference between short-term trend following and trend following hourly bars. And so you can spend a lot of time debating and arguing these topics, but a lot of times it's just because people do things their own way, and everyone thinks, well, you should do research like I do it and set up your systems the way I set them up, and you'll come to the same conclusion. But people don't come to the same conclusions. and especially when it comes to the equities markets, when you veer off from using an index. Everybody wants to use the index. And I want to only look at it in terms of the individual markets that are going to produce these big outliers, but few of us are going to have the same portfolios.
Hi guys, another time I want to say that I don't know, can you listen to me now or not? I have program issues today. I want to say that trend following works on almost everything I know, even in sales, even in relationships maybe. And I think, of course, there is no reason to speak, maybe think on this, to do research on the topic, does trend following work in stocks? Of course it is, but we must be diversified and to choose, even if we trade only in stocks, we must choose stocks from different areas, from different fields, from different companies. And I think stocks, Jerry said that not from the index, not main stocks on the index, SP500 or Nasdaq, but a lot of different small companies, and it will be more diversified than if we, for example, if we choose stocks, top stocks from the S&P. I think if we trade only stocks, we must choose it properly. I think different stocks, really different, only this. So diversification is the key here. But in the long run, all this works well. And if we apply, I have said before that if we apply Transform to I think almost all areas of life I know, it will work in very different areas of our human being.
Hello.
Yeah, Jerry, I wanted to ask. I've followed you for quite a while now. I've listened to you on YouTube and just hearing your interviews, nothing but inspirational. Out of all these years, hearing people talk about trend following, how it works, how it doesn't work, whatnot. What would you say is the one thing that really gave you the conviction personally, apart from the money? What was it that gave you the conviction about trend following, working as a principal in any and all markets, that really gave you like, this is what I'm doing, nothing, nobody can tell me anything different? What was it for you?
Oh, well, that's a good question. Well, I would say that, I don't know. I mean, I could come up with a better answer probably if I had more time, but the first thing that popped into my head was really just, I think you need to look at the markets as you're not sure if what you're going to do is going to work necessarily. It would be nice if we could all make a good living and make lots of money, but it may not be the case. And so, but there's something even worse, and that's losing all of your money or losing too much of your money. So I just look at it as whether it makes money or not, I hope it does, right? But I definitely want to go in with the best strategy that is not going to lose too much money. And so I'm going to be maximally diversified. I'm going to take those small losses. I'm going to be very conservative on my trade level, increasing my leverage and my trading size slowly, but I'm going to be very quick to decrease it fast if I'm losing too much money. And then maybe I will be lucky enough to catch a lot of these outliers and I'll make some money. But I just don't see that it's possible to deconstruct that strategy and desire to get rid of any of those components. Like, okay, so it's not going to work, so let's trade fewer markets. No, I'm not going to do that. It's not going to work that great, but maybe if you don't take small losses, it'll work. No. So first and foremost, I'm going to preserve capital. I'm going to try not to lose too much, try to stay in the game, and then I don't agree with this philosophy. I don't like when people say, and the profits will take care of themselves. I don't like that idea because they're not going to take care of themselves. You need to have a good entry strategy and a good exit strategy, and don't shirk that responsibility and write it off with some cliche that, well, I'm doing all I can on the risk control side and just let the profits do what they want to do. No, because they won't. You need to be good at exiting those profits. So anyways, I think it's just an elimination of, do I want to do anything other than this when my primary goal is to risk control, stay in the markets, preserve capital, live for a long, long time, and then we'll see if we get those outliers. And I have mishandled outliers over the years and paid the price, so that's good. I have a lot of negative reaction to not following my systems. I have not followed my systems and not made as much money, so that's a good, that's good for me because you always want to do whatever it takes to convince yourself you should follow your systems. So I just think it's a process of elimination. And to some degree, when I first heard about trend following when I was 20 some years old, my mid 20s, I just asked myself, oh, I get it. This is wonderful. It's beautiful. Shorts are great. Diversification is great. Are these big winners going to pay for all these small losers? And I felt like that was something I could handle psychologically. If you end your career or end a year and you just broke even or lost a little bit and the big winners didn't pay for the little losers, then so what? You can live with that. And so I think this is a low regret strategy. I'm not going to get depressed if this doesn't work. It was the best shot. It was the most conservative shot. It has worked in the past. And I can be criticized, rightfully so, for people saying, you shouldn't choose systems like this that rely upon these outliers. Yes, that's a bummer, but it has been a tendency to work very well.
I will follow with this, and of course, our roles as a part of a system as a whole, and of course, we must have these good rules, and of course, we must follow this, and without a proper risk management, I think we will lose all our money. And without a diversification, we can wait for 10 or 15 years, or maybe even 20 years on a single instrument. And we see this, for example, with Qualcomm, and we saw this even historically on the stock market when it was periods of 15, 20, even 25 years, I remember, of underperforming of stock markets, on a buy and hold strategy at least. So of course, it's first and foremost, it's diversification. It's our enter X diversification and risk management. So it's a system. This roles as a system as a whole. And so not one component, but all these combined components give us perfect trend following solution. I'm sure about this.
Yeah, and Jerry, the reason why I asked you that question was because I think just before COVID, I don't know if you can hear me, hope everyone can hear me well, but just before COVID, David Harding, who's one of the, probably, obviously, one of the famous trend followers, he came out saying that basically trend following doesn't work. And then obviously the craziness with oil began. And then you started seeing articles coming out saying that he's back on his 14-year run. And it's like, I don't know. That's why I asked that question of conviction, because I mean, anyone can try any system. But the one thing that I've learned from great people like yourself who are in the markets is that they always have whatever they're doing tailored to who they are. And I just think that self-awareness plays a key part into success. So hearing what you were saying now, it was just one of those things where I just feel like, if trend follow, it's not that trend following doesn't work. I think it really is an individual thing that if it's not tailored to you, you're always going to see problems with it. Because when I hear your mentality, there's a key word that we've all heard whilst you were speaking, and that was the word outliers. Like, you're not thinking of anything else, but really just taking advantage when your hand is strong. If you have a strong hand, you're going to go for it, right? But I don't think that's the mentality of a lot of people who are trying to do the trend following, where they're looking for outliers. They're just probably, trying to make money. But when you're looking to take advantage of real opportunities, like you said with Tesla, Tesla was a monster. Even in the crypto space, I was shocked that there wasn't a lot of trend followers who were getting into crypto, and it's funny because crypto beat stocks for the past, was it like 10 years? Like from, I think 2011 to 2022 was the best performing asset or something like that. But it was just fascinating to me how the adaptability of some trend followers is not as strong as what I thought it was. But going back to what I was saying before, it was all that message on conviction. I just wanted to hear it from you in a sense of where like you just confirmed something that I knew, but just to hear it from you that like it is an individual thing, tailoring trend following to your personality. And obviously with certain people, they probably don't even have it within them to.
Well, I think that's better. I mean, people who heard me speak, I got to stick with what I believe. So I think it's actually better to tailor ourselves to what works. And I think I'm in a minority on that because everyone has that same idea. Find something that works for you. If it's good for you, as if everything is equal and every idea is the same and we're not going to criticize each other. There's no pursuit of the best. I think there should be a pursuit of what's the best. I can learn, I can improve. I may learn something today and have to admit, oh, I was dead wrong. I've done that before on these spaces. People have said things to me, and I've said, oh, yeah, you're right. I need to go change some of my parts of my system right now. And so I think it's better to have the mentality that I'm pursuing excellence, and it's a lifelong pursuit of great trading, whether I like it or not. I'm the one who needs to change, not the markets. And I think there is some caveats to that, especially trading size. If you need to be very conservative, yeah, trade small. That's your own personal decision. If you want to take on big, huge risk and make 100% a year, I made 200% a year for 4 years in a row back in the 80s. So that's your personality, granted. But I don't like the mentality of everything works. It's what's good for you. There is a situation where if you understand trend following, you want to adopt trend following, maybe you can't do it. So do something else in life. But I don't think you should convince yourself, lie to yourself that, well, I'll just change my trend following around to something that's less robust, less profitable, because that suits my personality. I'm dead set against that. And then I think another thing you brought up, which was pretty interesting, was trend following doesn't work. Some people think it doesn't work. David Harding said it didn't work. I think one of the interesting things is that word work. And that word work means so many different things to so many different people. Like for me, it doesn't include Sharpe ratio or volatility. For other people, it absolutely does. We can show you the Sharpe has gone way down since the 80s, blah, blah, blah. I don't care about the Sharpe. So that's not a metric I use to determine whether it quote unquote works. But for most people, that is a metric that they use. So my metric is, does the winners pay for the losers? Can I risk a small amount per trade? Am I on the big winners? Do I get bounced out too quickly? Do I stay in too long? Am I making great money on these outliers, irrespective of the volatility and the profit giving back profits and the drawdowns? And, Michael, I didn't want to say this on Twitter, but Michael tweeted something like, I thought it was funny, because people talk on podcasts and they tweet things and they inadvertently, talk about positions that, like I remember Mark was saying a few months ago, like everybody is short wheat. Well, I was still long. And Michael this week said, anybody who's still short treasuries needs to look at their system. Yeah, I need to look at my system because I'm still short treasuries. I just think it's funny. And because, there's different styles and strategies, and almost every trend following system works. It doesn't matter how short term you are or how long term you are, within reason, but it just works differently. It works different on every trade. the expectation of, is this trade over? Has the expectation turned negative? It depends on if you're following the system. If your system is great, it's been great in the back test, and you're still short treasuries, it's still a great trade. System 4 is still short. System 1 is long. They're both perfect. They're both doing what they should do. And over time, not necessarily on this particular trade, but over time, they will do really well, make about the same amount of money, and you'll be very happy. For a trend following trader, systematic trader, there is no such thing as looking at the chart and saying, I should get in or I should get out. It is, where's the entry? What is the exit? Does this system test out well in the back test? Follow that system. There's no such thing as has the trend changed. It's not about the trend changing. That's a subjective statement. You need to embrace the objectivity of following entry and exit rules.
I want to say here that when a person says that trend following doesn't work, it sounds maybe for me that a person from a desert says, I live in a desert, rain doesn't work. Rain does not exist. There is no rain in the road. Yes, but in a desert, maybe such a climate, there is no rains. But if you go to the Baltic Sea, to Denmark, there are a lot of rains there. So we must have a diversification, and we don't know, maybe in this desert part of the world, the climate will change and there will be a lot of rains in the future. We don't know. So for me personally, trend following is a part of general laws of nature. So it can only work. And there is, like Neil said, it wasn't written any white paper that it proves that trend following doesn't work. So trend following works and works perfect. And there is no evidence that trend following does not work. It's no evidence of this. And only evidence that trend following is the most perfect strategy we have.
Hey, Jerry, I refer to long duration or TLT, ETF, short-term positions, not trend following. But anyway, my trend following algo is short of the 10-year from January 6th, and it's up biggie. So when I made this tweet, I was referring to TLT ETF only. That's a long duration, 20 years, short-term trade, and this was going up anyway. I want to ask you a question. I don't know if it's a good question for you or if you have the numbers or willing to answer. On the average, what is the fraction of your capital, your AUM, you are using for margin, and what is the leverage based on notional? Thanks.
Well, I think that looking at the margin is not as accurate as looking at your positions in terms of the ATR to entry or the current ATR, and seeing what kind of positions you have on. The margin is not as accurate because the FCMs don't update the margin as frequently when the markets get very volatile, and there's different leverage amounts. For futures, maybe it's 10-to-1 leverage, and for stocks, you'd be lucky to get 5 or 6-to-1 leverage. So I don't think that using margin it's not as accurate enough for me, but I think our margin to equity usually runs 10 to 15%. And then I risk 15 bips per trade. I have a healthy stop loss, so the market has to go a fair amount against me. So with 300 markets, and I'm doing one trade per year, and I'm risking 15 bips per trade, and my winning percentage is only 40%. So I think using some of those numbers, you get a better sense of the type of risk I'm taking on, and I'm not ever scaling back. So I might have on 4 units, of trades, but they're measured from the entry and the entry ATR. But I also look every day at the risk in my portfolio using the current ATR for each market, and that risk can be more than those 4 units. So it could be 5 or 5.5. So as a good outlier hunter, I am not scaling back those trades when the ATR doubles, triples, quadruples. I've seen it go up 10x from when I put a trade on. So that's very uncomfortable. But that's how you get the Tesla. Moderna was the other big mover. I forgot. I probably got the Moderna shot and I forgot the stock already. But yeah, it's very uncomfortable to sit with. But that's how you make these big 500 ATRs. It's 500 ATRs was probably $1 in Tesla. And it probably got up to 50 or 100. But yeah, I think once I was asked by a very large client to tell them the amount of notional I had on, and it was a shocking number. Because we trade so many markets that are low volatility, the short-term interest rates, currencies, the bonds, the whole philosophy of CTA, trend following, money management, turtle money management is to trade the low vol trades large and the high vol trades smaller. That a lot of times it just depends on, how many short-term interest rates do you have on. And so you can get the impression that because you have to buy so many of them or sell so many of them based upon their low vol, that you have this huge risk on. And then, sometimes you do because, we had, I was short euro dollars in October 87, when they opened up like 350 after the crash, the stock market crash. So you can go around for long, long periods of time thinking you're trading small and you have your risk under control, but markets like the short-term interest rates can explode against you, and you can absorb losses that you never thought were even possible.
Jerry, you mentioned in a DM a fund, I don't want to mention the name, that was doing very, very well this year, 100% plus. I think there is no good metric to compare CTAs because the MAR, for instance, the annualized return over the maximum drawdown, it depends how much they are risking. Do you agree?
I don't think there's anything more important for me and for classic trend followers than how much you're risking per trade, my 15 bips. And then what's the total number of markets in your portfolio? 300 times 15 bips. If I traded 150 markets, I would risk 30 bips. Now that's from a classic trend following point of view, where we're looking at these discrete trades, entry, exit, stop loss. We're not really paying much attention to the equity curve and the volatility. And I think in resizing our positions frequently, when vol goes up, we get out of some. When vol goes down, we increase. And that to me is a little bit more dangerous because you have to be very quick on your feet. That when you're increasing these positions, maybe a year after you put them on, because vol went down, you may have to very quickly decrease them. We've seen this before in the August of 2018, where the S&P slowed down and the vol was very low. It had been in a really nice uptrend. And so I'm sure vol management CTAs added to those positions, as they're wont to do. And then shortly thereafter, they had to unwind extremely quickly to save their portfolio. So there's a positive and negative to this constant volatility management. It sounds like great. I'm managing volatility. Pat me on the back. It's just fantastic. I'm getting out of these great trends because the vol's too high. Now I'm adding to these great trends because now the vol is slowed down. You just got to be really quick on your feet and be careful not to get caught into a situation where it's spinning out of control and the vol is heating up way quicker than you can get out. Whereas I'm sitting back lazy and looking at this as, well, I'm not going to increase my trade level very much. It's going to be very slow as I make money. And I'm not going to decrease or increase my positions. It's 1 out of 300 markets. I'm riding this trend. It's going to be uncomfortable to give back a lot of profit, but I'm going to make more money. And one of the dirty secrets of volatility management, which I've said a million times, is when you've managed the volatility, you have to trade larger. You have to risk 20 bips or 25 bips rather than 15 because you are taking smaller profits. And so, which is fine theoretically, because you're trading a more efficient system. So you can leverage it up more. We all leverage up because based upon historical diversification and correlation and profitability. And so they leverage up one more time because they've got a more efficient system. However, something rubs me the wrong way about that. I'd rather risk 15 bips of capital rather than 25 and move that risk to open trade profit and volatility where it's not eating away at my capital.
Yeah, one of the things that concerns me is that I think trend followers are much more conservative in their approach, in that there are two ways to lever up your portfolio in relation to the non-linearity of these asymmetrical returns. One is to rely on the market data itself, which has non-linearity in it, to deliver your outliers, or the other is to apply aggressive position sizing for your system to incorporate leverage into it to get the benefits of non-linearity. I personally think it is far safer to let the market price itself do the lifting power of your portfolio rather than relying on the position sizing algorithm to accelerate your returns. Because when you're applying position sizing methods to apply leverage to returns, what you're doing is you're relying on that system actually being relying on the predictability of that system to be able to aggressively position size. So you're applying a Kelly formula effectively to your system based on its historic returns, with the assumption that those returns are going to be consistent and stable. That's when a lot of people start aggressively leveraging up their systems with position sizing, but that gets them into extreme risk territory when the predictability of that system is lost. So a trend follower, through his diversification principles, is not using position sizing per se. They're using diversification, small bets. They're using the non-linearity in the market price itself to do the lifting of their portfolio, as opposed to a position sizing algorithm that's aggressively embedding leverage into it to aggressively get this non-linearity in performance returns.
Exactly. And I think that you bring up a very good point, which is at the same time, you can have these wonderful, great, robust, back-tested trend following systems. And you look at these things and you're like, wow, this is quite amazing. I'm really happy with this. And then someone can point out, well, it is sort of lumpy and bumpy. You're like, yes, that is true. But my lumpiness and bumpiness is it's going to be more directed towards when I'm profitable than when I'm in a choppy a period of losing money. But the mentality of that person who has, not me, I'm not talking about me, I'm just talking about theoretically, the proper the proper approach is
Hey
that
guys.
I have this great systematic approach and these great systems, and I do not trust them. Not ultimately do I trust them. No, no, no. I do believe in them, and I'm going to follow them, but I'm going to have a tremendous skepticism of how they've done in the past. And I'm not going to get cocky and leverage up. I'm not going to assume that it's going to look like the past is going to look like the future is going to look like the past. I'm ready to scale back if I have to across the board to preserve capital, even though I'm going into battle with maybe the best systematic approach. So you want to have both. I really like what I do, but I'm not going to do anything in these markets, these dangerous markets, to press these systems as if I can rely too much on what could happen in the future. Bad things can happen, and you need to go in with the best possible strategy and the most humbleness as it relates to bad things happen. I need to stay in the game. They can fail for a while, and then I'll go right back to trading the same strategy in the future. And I think that's where you want to have both of those. It's not a contradiction. We love what we do. We love how we do it, but we don't have, this is not religion. This is not God. This is a man-made system that can have some ups and downs. And your ultimate goal and everything about trading is to stay alive and preserve capital so you can trade when things get better.
Now that Richard is back, I have this belief that above a certain threshold, CTA returns are mean reverting. So I would I would prefer a CTA who does 20%, about 20% every year for 5 years than one that does like flat for years and then earns like 100%. I would like to do this study, but I don't have time. I don't know what you think, Jerry and Richard.
Yeah, with the volatile returns, obviously compounded wealth is affected by severe drawdowns and they are path dependent. So you do, ideally in our world, we would love the ascending equity curve, but the problem is with it. So that there are two ways that people try and achieve that. The first way is they adjust their position sizing for periods of low volatility or for periods of high volatility to try and smooth their equity curve. I'm not really a big fan of that, but I personally think it's through diversification, through how we distribute the outliers through our trade distribution of returns. So through our diversification and through the deployment of our systems that are not always on at the same, at all times, they're very selective when they're into trends. I do believe that with extensive diversification and really thinking about the markets that are in your universe, how uncorrelated they are from a logic perspective. So in other words, if you are investing in stocks, you're looking at the logic of those stocks. If they are a highly diversified company, then avoid them because they're not necessarily going to produce those outliers that we're after. But if you are looking at a particular stock that by its very nature, it might be investing in eggs, or it might be investing in something else, chips or something like that. Things that are totally uncorrelated to each other, which are independent to each other, I believe through the logical assessment of the stocks in your universe and the logical assessment of all the markets in your universe, you can significantly make inroads to make it a very uncorrelated portfolio, which means that you get very wide distribution of outliers throughout the time series. That's what we're after, because then we don't face these times of very long periods of stagnation, which I do believe have a significant negative impact on compounded wealth over the long term. So we want to try and get as much distribution of these outliers across our time series, and that I think the secret of that, or the secret source of that, lies in your selection of your universe. In a logic-based approach, as opposed to a historical correlation approach. I think it's best to, correlations are moving feasts. They continuously change. I think the logic is going to save you, as opposed to your assumptions regarding its historical nature or its correlated nature.
Well, one way to smooth equity. When I traded for a hedge fund, I was trading stocks and ETFs. Some people that work with me, they smooth their equity buying small caps. They move them up. And this is a good strategy until you hit the risk of ruin. And it works until, I remember one guy got ruined doing it for many years. He did very well buying these small caps, trend following, and then he got ruined doing it.
I was just thinking, like, when I walk my dogs, I get really philosophical and start thinking about trading. And a lot of it, too, is dependent upon what's going on in the markets. But I was just thinking how important it is to, I think what kind of works in the markets is so counter to the way we want it to work. And I think to some degree, if you could just, I don't know, do less. I've got these systems that they don't do a lot, and they absolutely do nothing to help me not give back profits. And I think that's one of the secrets, to trading is, and this is so counterintuitive to human beings, you just cannot go through a profitable period and not try to manage this equity to some degree. And I think that's what the ultimate desire is for the vol management and rules that are like, well, at some point in time, I'm going to do what I do with my losses. I'm going to cut my losses short, and I'm going to cut the losses on these profits short. I cannot bear to give all this money back. And I think to the degree you're able to implement a strategy that is purely following this rule and the rule has no concern, and there's no element of profit protection in the rule. I think, and I don't think anyone does this. Like I said, I think when I have run these systems in the back test, I don't see anyone's track record that looks like this. And they're the best systems possible, and that's a given. We're going to choose systems that are the best in the back test and the most robust and things we can honestly think are going to work. So, but I do think that's a huge part of trading is your trailing stop could give all the profit back in a moment, or way too much profit for it to be comfortable, regardless of how short term or long term you trade. I think that is one of the secrets of trading, is to make it so uncomfortable. Then you kind of know you're onto something, and it's maybe kind of the ultimate research is I want to just trade things that are the most uncomfortable. I don't know. I'm just blowing smoke now, but I think that's what I've been thinking about this week, and it's tough to sleep at night sometimes because that's exactly how my systems work, and that's after 39 years of trading. This is conclusion I've come to. But of course, I learned this in 1983.
I like this idea very much. It's really very, very perfect and eye-opening, because in almost all areas of our, at least in business, I see the same things, that we must feel comfortable in the circumstances where most of the people feel uncomfortable. And I think it's a good sign when a lot of people say to you that you are doing a wrong thing. A lot of people would say it's a wrong thing, it's uncomfortable, it's something wrong, you must do something more complex or more simple, etc. I think it's a good sign that we feel comfortable in that circumstances where others say that it's not good to be in such circumstances, not good business environment, not good idea to have such long trades, so on and so forth. It's a very big secret, by the way, very big secret, and not only in trading. I think in business, at least in business in general, it works the best way, and I know it exactly.
noticed that Moritz is here, and I noticed that he's got into poetry lately on his Twitter feed. So, how are you going, Moritz?
Hey, I'm doing fine. How are you, Richard? I didn't acoustically understand. I got into what on Twitter? I didn't
A
hear
bit of
this.
poetry.
Oh yeah. Oh, so I was playing around with this OpenAI. Did you try it out or give it a go? It's kind of amazing. I asked the computer to write a poem about trading, and it just came back beautifully. If you've seen it, I posted it on LinkedIn. I thought it was absolutely fantastic.
I saw
Strange.
it, and it's better poetry than I can do myself. That's for sure.
Yeah, exactly. Computers can do everything better than I could possibly do it, so I use it for everything. Just uh, you and Jerry, Richard, you and Jerry, you just did bring something up about this nasty topic of dynamic position sizing, and I really wanted to put this to bed and never speak about it again. But you've just mentioned something that got my head a little bit spinning, and I tried to understand it better. So sorry for asking it again, but you just mentioned, I think, if I understood correctly, that if you have a volatility controlled trading process, then going into the trade or looking at the portfolio in aggregate, you have to trade larger versus me or Jerry or Paul Mulvaney or you, Richard. And and can you explain to me again why you think that is? I mean, is that a function of the volatility level that trader is targeting? Say it's, I mean, make two extreme cases. Say, one trader targets 5% vol and the other trader targets 40% vol, and the three of us are kind of like whatever, in the middle between 15 and 20 or 25 even, but without the dynamic position sizing overlay on top. Why do you think would both of these traders have to trade larger? That I found very interesting. All the other stuff I need to put to bed, but this one got my attention.
Well, I mean, this is just a function of my research, and but I think it makes perfect sense. So, for instance, you're in Tesla, and we're both long. We're both long 1,000 shares. I'm going to hold Tesla to the bitter end and keep those 1,000 shares, make more money than you because you kept adjusting for vol, and I'm just going to make my average win is going to be larger. Now, the counter to that is, yeah, it's larger, but your vol is out of control. Moritz, who continued to vol manage, much more efficient, much higher Sharpe ratio, he could offer to lever up, which we all do. When we come up with better classic trend following systems, and we add more markets, we might leverage up, but we're leveraging up on one entry, one exit, and a stop loss. Very robust. They're leveraging up on less robust. It has a few more bells and whistles. Is it too less robust? Is it dangerously less robust? I don't know. No, I say no. Let's just say no. But they're going to have to trade a bit larger, which is fine. I'm just saying that their average loss is going to be a bit more than my 15 bips, because my 15 bips was it fooled them. I'm trying to fool them. They see how I'm joking, how I'm fooling them, which is, yeah, you're risking 15 bips, but towards the end of the Tesla trade, you've got this huge trade on, and we don't. And our volatility and our equity curve and our Sharpe is so much better and normal. And leveraging up on a more efficient system, i.e., trading larger. And one of the implications of that is your 60% losing trades are going to be a little bit bigger losses, which I think is like a no-go. That's no good. We have a system that makes money on 40% of the trades. We really need to concentrate on capital preservation. Of course, they don't agree that that's capital. They think the whole equity curve is capital. And then others will say, oh no, Jerry, wrong. I've seen situations where vol management, you make more on Tesla. True. Okay. You can come up with a situation in the back test where everything is wrong. Everything I say is wrong. It's not have you ever seen a situation where you make more money vol management. It's how does it impact the portfolio, and what does it look like over the entire test period? And over the entire test period, you can't have it both ways. You can't say, oh, we have a more efficient system. We're managing risk, this volatility, this equity curve volatility, and we're going to make more money, and we can trade smaller. Come on, you can't have it both ways. I'm not saying their choice is a bad choice. Obviously, I don't make that choice. All I am saying is it's pretty obvious that if I risk 15 bips, but if I, Jerry Parker, vol managed, I personally would have to risk more money. But once again, this makes me think of the Rob study that he did, where he wanted to put to bed how wrong we were. And he just did his back test in a way that you and I wouldn't do it. I
Yes.
would do my back test differently. So it's a morass.
Yes,
It's chaos.
it is. I remember from the test that I did that switching on the volatility control resulted in a larger average loss per trade. And that I didn't like. I mean, many other things I don't like as well. The fact that, your loss actually isn't defined when you think about a position that starts moving against you. We would at some point get out and take the risk off the table, realize that loss that we have budgeted for. Whereas the volatility control trader may actually ends up with a larger loss if on the way to that stop, he or she has increased the position size. So there's all these things which are kind of like anathema to the way I'd like to trade. Now, you could maybe say, maybe holistically, that the more bells and whistles you add to any system, and let's just say volatility control, it is an overlay. It is a volatility-based overlay at the end of the day that has nothing to do with trend. So you add one of these layers and you add another one, you find another parameter, all the degrees of freedom, you throw them out of the window, you make everything, here's another filter, there's another parameter, whatever. The backtest looks smoother because otherwise you wouldn't do it. And maybe therefore holistically you could say, yeah, well, the smoother you have that equity curve, therefore the larger you trade in terms of leverage and notional, because in order to kind of like get to the same return. But what you're missing, what you're not seeing in this backtest, in this historical thing that looks so smooth, is it doesn't jump at you. It doesn't give you the risk. It doesn't show you how the risk would have realized. You're just looking at the world in the rearview mirror, where your overlays have just worked fine for what you've chosen. But once these markets are unleashed, the future sequence of returns, which are non-normal, very wild and weird, then you blow up. And that is why I think we have the way safer setup in the long run. I'd rather trust my system with kind of like 3 parameters. That's kind of what it is, as opposed to anyone's system with 12.
That's right. And we may end up, realizing at the end of our career that we were too careful. We were too safe. We could have vol managed. It was not too much overfitting up to the past. And there were not these hidden problems in the future. We just choose like, well, if you're going to make about the same amount of money and I'm going to take smaller losses, then I'll choose that. And they chose something different. And they had a lot more money under management as well, because that's what clients like as well. And we're making the clients eat broccoli, and they're saying, no, you can have a little bit of steak and dessert with that as well. And we're saying, well, I don't know, I'm going to choose the safer approach. And then they go so far as to say that adding to positions, when the vol slows down, adding to positions works wonderful. And to me, it just says, seriously, so the breakout is inferior to a slowdown in vol and you adding to a position. And to me, this is just flabbergasting. But maybe I misunderstood your question, Moritz, because I thought you were asking me to justify taking larger losses and trading larger, but then you said that you had come up with the same results in your back test.
Yeah, no, exactly. No, I wasn't. I think you misunderstood. The thing that intrigued me is when you said that the volatility control trader, not not me, whoever does it, Winton, that they need to trade larger, and I think I understand why that might be the case, because it's essentially every overlay or every additional thing that you add to the system, at least in the past, will have probably made it nicer and smoother, and therefore you can put more leverage on. But I immediately, and maybe prematurely, jumped to like a world where I'm looking at two extremes. So I was thinking, okay, what if somebody targeted 5% vol, and what if somebody else targeted 40% vol? The person targeting 5% vol will probably trade very small because it's only 5% vol. He or she would trade smaller than you and I. But then I think we're comparing probably apples to oranges, because we shouldn't compare the 5% vol trader to us, or to Mulvaney, or I'm not sure if I have an answer. Maybe I just maybe I got a wrong thought. I don't know.
What I find when I'm comparing the different programs, so sitting on the outside, we've got Mulvaney, and we know that we know Paul's volatile, but he has, over the last 22 years so far, he's sitting at the top of the pops in the trend following world with the highest KGAR, but he does have higher drawdowns. But when you compare something like Man AHL, TransTrend, etc., they've got much smoother returns. So they, the consequence of that is they've got smoother returns, but the reality is they've actually got lower KGAR over the period. So then the typical thought is that, oh yes, but our process is better because if we leveraged up our return series, we could outperform Paul Mulvaney. But the bottom line is they haven't. They haven't. Paul is sitting at the top of the pops at the moment without vol control. So what is the reason for them not leveraging up their portfolio? Is it because they're satisfied that their investors are getting these smooth returns and sufficient KGAR to sort of justify their AUM? Or is it because there is this knowledge that they have that there is an intrinsic problem with leveraging up their models to outperform Paul Mulvaney? That's a question I've got.
And near 30 minutes ago, I have wrote the start to this discussion. I have wrote that I don't see the reason for myself personally to be more complex, more risky, and less robust. So, of course, I know the problem when I can't be as diversified as I want to be, of course. But I think for this situation, it's a better decision to be a more short-term, and even to use some filters, but not this volatility adjustment, not this vol targeting, because I have near 6 years ago, I have told this before to you, I had experience with vol targeting, and I made a conclusion that it's, as I said before, more risky, less robust, and more complex, and no reason for me personally to be in these circumstances, to do this. I don't know why it's better. Really don't know. Don't understand. So it's not my way. It's not my way to be a vol targeting trader, I think.
Hi guys. I mean, just to break it down, in the past we've spoken about that. So what they are doing is, their definition of trend is different. So these guys are trend following price array and volatility array, at least, So this means that, for instance, what's a classic trend trader like myself is doing, that I'm trend following price array and exiting with the stop loss or exit. So, but what they are doing is they are entering and exiting with the price array, they're entering and exiting with the volatility array, and they are exiting 3 different ways: stop loss, price array, and volatility array. And they are doing it all the time. So they do have 6 buckets. But if they incorporate the portfolio heat and the correlation, this means that actually they are trend following 4 arrays. So that's why, it makes perfect sense when we say that they are doing dynamic position sizing. But actually, if I would have coded a system like that, it would have made much more sense to me to say that, now I am trend following at least 4 arrays, which in the volatility, but if you're just going to simplify it and say that there's price array and there's volatility array, so the trend following becomes, in this instance, a little different. So you're not trend following price, but you're also trend following volatility. And every day you're entering and exiting with the volatility. So this is an much more complex model in the sense that your sample size is going to be quite low, especially on the long term, because the total number of trades is only so many. And if you're going to distribute it into different buckets, which is 6 buckets or more, if you're trend following 4 arrays, with 5 different types of exit, you have 20 buckets. So the question is whether you will have enough trades to fill in those 20 buckets, and what does it mean for you? And the complexity of the process is also is another question, really. Thanks.
Nice help.
Thanks, Al. Sorry, I have to run, everyone. 9:59, another great session, and thanks for joining. Thanks for the regulars. We will pick it up again next week. Monitor the Twitter feeds, a lot of good discussions going on there, and send me some questions and comments. And have a good weekend. Take care.